Good morning, traders and investors around the world. Welcome to the second day of August, this August 2nd edition of Pre-Market Prep Plus. Joel Elconin, joined by David Chiaverini from Wedbush Securities, covering the banking sector and disruptive finance. Well, the market's being disrupted this morning by the Fitch cutting the U.S. credit rating from AAA to AA. Doesn't sound too bad to me, but the market's taking it on the chin. We're down 32 and a half handles, 45.68.75. The buck up modestly, up 13 and a half cents at 102.22. Bonds down again, down a half a stick at 122 and 14 30 seconds. Crude makes a new high for the move, but peeling back, up 30 cents at 81.67. Gold and silver going in opposite directions. Gold up 280 at 1981.60. Silver in the red by about a nickel at 24.28. And Bitcoin futures, they're up $225, 29,665. Let me stop the screen share here. Bring in David Chiaverini over there at Wedbush Securities. David, how you doing on this Wednesday morning?
Things are great. Thanks for having me on.
Yep. So I just briefly want to, touch on this. I mean, credit rating downgrade, but it's definitely wreaking a little bit havoc in the market. But what, does this really, does it affect the big banks now? Maybe in the longer term or never? What's your outlook on that?
Yeah, so I'd follow up on your comment about how bonds are, trading lower. So yields are going up. And so higher interest rates, what we've seen over the past, 6-9 months, higher rates is negatively impacting bank fundamentals. The funding costs are getting pressured that much more. So with higher rates overall, we're probably going to see that funding pressure continue. So I would say this is a negative for the banks. And then higher rates overall in the economy are going to lead to, presumably slowing economic growth. And that could lead to, weakening credit quality. So the loan portfolios at the banks could see some weakness as this kind of ripples through the economy. Now, it won't be overnight. These things take time. I would think 9 to 12 months out, we might see that credit stress start to come through. So bottom line, as it relates to the credit rating downgrade, I would say it is a net negative for the banking industry.
Okay, I can't remember the last time I had you on the show, and if it was in the midst of the banking crisis or not. But is it the banking panic behind us now? And still, what are some of the headwinds in this new banking landscape, this new environment?
Yeah, so the good news is that the panic is squarely behind us from March and then early May when First Republic went down. So that part is clearly in the rearview mirror. So collectively, the banking industry could take a deep breath. Now, with that said, in the wake of that mini banking crisis, is the banks are contending with a very intense competitive environment for deposits and bringing in deposits. Not only are the banks competing with each other to bring in deposits, they're competing with money market funds and the high yields on those money market funds. So they are contending with continued net interest margin compression is what we saw in the second quarter results. We've seen a mix shift on the deposit side from non-interest bearing deposits into interest-bearing deposits, so that's pressuring funding costs as well. Now, banks in general are calling for a stabilization in net interest income trends by year end, but I'd have to, caution that banks in general have been underestimating how much their funding costs are impacted and going up. So I wouldn't be surprised if we do continue to see pressure on net interest margins a little bit beyond where banks were kind of messaging through this earnings season. So we are still, in this sort of cautious view that we have here at Wedbush as it relates to banks. Now, with that said, we do still recommend a number of banks in our coverage with outperforms, but nonetheless, top down, we are cautious with this market backdrop.
Well, if they want to garner more deposits, then why don't they come up to competitive rates for I mean the money that I've been putting to work in cash and stuff, and it's not at my normal bank. I mean, they're not there. Would that be a way to attract more deposits?
Absolutely, and we're seeing a number of banks do that. But as you would suspect, paying a higher rate does negatively impact your net interest margin, because the banks are getting a certain amount on their loans, and then what they're paying out on deposits, that difference, their spread is how they're earning money. So if they're paying more on one side, the liability side of the balance sheet, then that's going to squeeze their net interest margins. So that's the main issue that we're kind of seeing here, is that mix shift from non-interest bearing to interest bearing, as CFOs as well as individuals want to earn some money in this higher rate environment. So yeah, some banks are being very aggressive in increasing the deposit rates, both on CDs as well as their savings products. But at the same time, we're seeing those same banks kind of lowering their net interest income guidance outlooks because of that additional funding pressure.
So what's going to make the NII, they're having these downward revisions. What makes you think it's going to slow by year end?
Yeah, so this mix shift that's occurring has sort of run its course for the most part, or continues to run its course. Now we're probably in the later innings of that mix shift. But for instance, you mentioned yourself how you've put some money to work in higher yielding products. Most people at this stage has already made that move. So now that that's occurred, should lead to some stabilization later this year.
All right, let's talk about the Fed and the outlook for interest rates here. I think that we finally got people off the Fed pivot in 2023. They finally, even though Jerome Powell pounded that into our head that they were not doing a pivot here. I don't even know now. Maybe in 24. Just talk about the Fed, the pace of interest rates. When I'm looking for, and when I talk to people about the investing environment, is like those days of free money are gone. The days of getting that low, you had such a confluence of events that that caused the Fed to just open up the spigots, primarily COVID. Why can't the market just stay here? As far as interest rates, why can't people earn 4 or 5% on their money? Relatively risk free. That's what I'm looking for. I don't know how much higher they're going to go up, but are they going down, or do you think they're going down like back to the ridiculous levels they were at?
Yeah, no, not at all. And I think higher for longer really is the base case. I think the market kind of got stuck in this mindset of interest rates are either going up or they're going down and not sideways. But we can have a situation in a scenario where they do go sideways and in this higher for longer. And the other thing is, I think the Fed essentially wants to see, how their existing rate hikes kind of filter through to the economy. So Powell has said they're going to be data dependent. I think that's kind of code for, we want to see if what we've done is actually going to work in slowing the economy and getting inflation back down towards, that 2% level. And I wouldn't be surprised if, just like we saw the pause and then a hike, maybe we get a pause for another meeting or two, and then another hike for a couple times if we don't see that inflation, end up coming down. But I think you nailed it in saying, we're probably not going to see any pivot, certainly in 2023. And from the sounds of it, Powell is trying to message that we could be in this higher for longer for the next couple of years, for that matter.
Okay. All right. One thing that Fitch cited was with loan growth and that slowing. That's got to be concerning, right, for the banks?
Yeah. Yes, absolutely. And we are seeing that pipelines as the management teams during bank earnings season discussed, pipelines are slowing. You've got lower demand, and we saw this from the senior loan officer survey that just came out on Monday of this week, where loan demand across all four major categories is slowing, and lending standards are tightening across all of the four major loan categories. So we are seeing it both on the demand side and the supply side that, loan growth is likely to slow from here. And, you nailed it in saying, this isn't good for the banks. Now, part of it too is the banks are also, restraining credit availability, partly because they're being more conservative in their balance sheet management. They're constrained by their loan to deposit ratios. Now, they got kind of spoiled through COVID, where there was this surge of deposits and took loan to deposit ratios to abnormally low levels. And then we had this mini banking crisis and saw this outflow of deposits. So it took that loan to deposit ratio much higher than where it was over the past, over the prior 4 or 5 quarters. And now bank management teams want to get back that conservatism in managing their balance sheet and bringing back down those loan to deposit ratios. So in order to do that, they need to grow deposits faster than they grow loans. And we were just discussing about how difficult the deposit environment is. So that necessarily means that they need to pull back on loan growth to keep that conservative balance sheet.
What about the credit quality of these loans? The EKS makes an interesting point here. Some of the regional banks may not help refinance the REIT loans. REITs, what about, that's one thing that I'm concerned about is like the commercial real estate market, these office buildings. Obviously, we've had a monumental shift in work from home mentality. I know that it's, getting back, people are getting back to the office. But is that like the next bubble to pop is the commercial real estate market? And also just talk about the general credit quality of the loans on these banks' books.
Yeah, so the general credit quality of the loans is still excellent, mostly pristine. We are seeing some one-offs here and there of charge-offs. And we're seeing episodic increases in special mention loans, which is, the term banks like to use for keeping a closer watch on certain credits. And it does seem to be commercial real estate where we saw more of the increases related to special mention loans. And it's going to take time. I am expecting, credit quality to weaken looking out to next year. But in the here and now, credit quality is strong. And the area of weakness, office got a lot of airtime during the conference calls through earnings season. As you noted, work from home as well as higher interest rates is kind of the double whammy that's impacting the office portfolios. So the reserve levels are going up. Banks are being, trying to stay ahead of the curve in terms of building those reserves to anticipate some losses coming through. And we're talking high single digit type percentages across some of the reserve building against office portfolios. And that is, that goes to show how significant of stress some bank managements are expecting on office. For instance, during the financial crisis, the peak NCO rate for CRE was 3.27%. You've got some banks setting aside 7-8% on office portfolios. So, and these are on loan to values of like 50-60%. So that goes to show that, they are expecting significant stress on the valuations of these office buildings. So the good news is that the office sector, the leases renew over a long period of time. So if the average lease length is 10 years, then you can see those cash flows and predict them, as well as the loans also have somewhat longer terms where you're not going to see 50% of all office loans come due in the next 12 months, you're going to see, say, 20%, 15, 20% come due each year. So that means it should be that much more manageable for the banks to handle the weakness for the office portfolios. But they'll still see the stress, they'll still see some losses, but it won't be an avalanche of losses. It'll be kind of a trickle over the next, call it 3-4 years.
Yeah, we had another banking analyst on last week, and he discussed that, a lot of the term loans are like they're like 24, 25 is when they're coming due. So, what's in the pipeline and what's going to be who knows where rates are going to be at that point. But just something, something to look in the future for. I'm going to rip through a few stocks here and you just make a quick comment, and then we can get all these in, and I'll let you go on this Wednesday morning. NYCB, a stock that I have owned since it was what bank did it take over? It was a Flagstar, right?
Yes.
Yeah. Yep. So I've owned this thing forever. I bought more on the dip back in March. I don't plan on selling it. Just quick outlet for NYCB.
Yeah, so New York Community Bank, they had a good quarter here. So what they're benefiting from is they acquired many of the assets and all of the deposits from Signature Bank through the FDIC assisted deal. And they are being aggressive in not only retaining those teams, but they're helping those teams bring back some of the deposits that had left. And they're providing the same incentive structure that Signature provided the teams. New York Community is doing the same thing. And they are quite optimistic that they're going to be able to bring back a lot of those deposits. And that is the crux of the value that a bank can derive. So the outlook for New York Community is looking, very, very strong in our view. And then on the expense outlook, they've spoken in the past about how they typically get 35 to 50% cost savings from a deal, and how they expect to be at the top end of that range for this deal. So on multiple fronts, New York Community is in a good place right now.
Here's one. I don't know if I've discussed or even looked at it. Customers Bancorp Inc. here. Wow, this thing got under $10, consolidated back at 20, and now it's a doubler here. Little too much, too fast on the rebound. Is this back? Oh, this is one of the few stocks that's back well above its April lows. Give us an outlook for Customers Bancorp Inc.
Yeah, this one we like as well. It had gotten just entirely too cheap, but fundamentally, they're one of the beneficiaries of some of the banks that had failed or wound down. So Silvergate Capital, crypto-oriented bank. Signature Bank also had a crypto business. Customers does also have a crypto business where these are deposits. They don't own Bitcoin, they don't own Ethereum, but they are providing and taking in deposit services from crypto hedge funds, and they're capping it at 15% of the overall deposit mix. So by no means are they a crypto bank, so to speak, but nonetheless, they benefited from those other banks going down. So their deposit mix shift going from interest bearing to non-interest bearing that banks would normally like to see, customers is getting. Again, interest bearing deposits is going down, whereas non-interest bearing is going up for them, whereas the complete reverse for most of the industry. So customers, they're one of the few banks that actually is seeing net interest income and net interest margin stabilization and growth recently, and looking out for the next couple of quarters. So customers is one to definitely keep on your radar.
All right, moving on. Western Alliance Bancorp, under $10, now over 50. Well, trading just at the $50 area. Nice rebound here. Western Alliance, I guess it's not going bankrupt like the other ones. Any comments on that one?
Yeah, Western Alliance, similarly. Yeah, they were kind of against the ropes during the mini banking crisis. But they fended and navigated very well through that. And in fact, they're now on the path of growing deposits here. So they're giving guidance of, quarterly deposit growth at 2 billion per quarter, growing loans at 500 million per quarter. So kind of to that earlier point about having a more conservative balance sheet makeup, they're reducing the loan to deposit ratio to make it more conservative. And we're also seeing a incremental rebound in mortgage banking, which is a decent part of Western Alliance's business, where mortgage banking income doubled from the first quarter to the second quarter. So with it trading, below peers, we think Western Alliance is a good buy here as well.
Okay, let's move on to some of the neobanks here. And let's start with SoFi here. Nice pop, nice comeback for SoFi here. Giving back a little bit from that earnings move. Oh, what an important level here. Trying to hold the gap up low at 1030 here. What's your outlook for SoFi Technologies?
Yeah, so we're cautious on SoFi, and we were early with our downgrade in May. But since our downgrade in May and some of the concerns that we raised, which relate to balance sheet constraints and their capital, but since our downgrade, there's been about a half dozen additional downgrades across the street. And to get into some of the things that we're concerned about, they've been growing their net interest income quite nicely. And CEO Anthony Noto, he has said that he wants to grow revenue at a 25 to 35% CAGR over the next few years. In our view, the only way they'll be able to achieve that is by raising additional capital, because their capital ratios, now that they are a bank, their capital ratios are a constraint on their growth, and their leverage ratio is the main constraint. It's in the mid-teens as of the second quarter. The company has mentioned that their comfort level is going down to 10.5%, perhaps with a buffer above that. And in our view, that gives them another couple quarters of balance sheet growth similar to the pace that they've been putting up over the past few quarters. And without a capital raise to support the growth, we expect sequential quarter revenue growth looking out to next year to slow meaningfully. And then this issue around fair value accounting, where they basically originate a loan, write up the value of that loan immediately. Now that the portfolio runoff in the portfolio has gotten so big that the runoff is accelerating faster than new origination growth. So that's going to put pressure, at least in our view, on loan origination and sales fee income line. So I think that there is a few headwinds here, and they're not profitable yet on a GAAP basis. They plan to get there in the fourth quarter, but nonetheless, we expect their overall consolidated ROE, not the bank ROE, where they are basically saddling most of the expenses at the holding company and having fewer expenses in the bank, where the bank has a high ROE, but on a consolidated basis, the ROE is much lower and frankly too low to support 25 to 35% CAGR on revenue for the next few years.
Wow. All right, before I let you go, I got to ask you about Upstart here. Holy mackerel. What a move from the May low, 12.52, over $70 yesterday. Can this magical run in Upstart Holdings continue?
Yeah, the quick answer is no. It has been a remarkable run, going up, 6x from the low, and we are expecting an inflection point with their origination volume in the second quarter versus the first quarter. But we do think that this is too far, too fast, and too extreme relative to the long-term funding partner agreements that they've gotten in place. We think that the economics related to those deals, while incrementally positive to the overall business for Upstart, we think that the benefit won't be as good in terms of magnitude relative to the stock price move. So our view is that the stock is likely to fade here over the next few quarters as results come in.
David Chiaverini, covering the banking sector, disruptive finance, giving us a lot of great information here. Thanks a lot, David. We'll be dialing you up again in a couple months.
Thanks a lot, Joel.
Okay. All right. Well, extended interview there, but love to hear information on the banking sector. Very important. Very nice run. We're up against the clock here on this Wednesday morning with the S&Ps down 33 handles at 45.68. I gave you guys my big number on the downside, that pre-market low 52 and a quarter. That snuggles right in with the low from last week. Must hold level. S&P looking at the rebound here on the rebound off that 52 low took us just over that opening price of 45.80 to 45.8350. So if you're looking for this to get back, maybe to unchanged or whatnot, let's see what we can do in the regular session. Joel Elconin signing out on this Wednesday. Back with you with the closing print, and it's going to be me and Josh today. We'll see if he can come up with another gem. Thanks a lot, everyone. Have a great day.